Hello. One of my five fund picks this year is the Brown Advisory US Sustainable Growth Fund. And I'm delighted that David Powell, one of the portfolio managers of the fund, has joined me today to take us through the fund and its approach. David, thanks very much for joining me.
Thanks for having us, Tom.
So let's focus on the name of the fund. Sustainable is obviously in the name of the fund. And I know that you talk about investing in companies which have a sustainable business advantage. What exactly do you mean by that?
Yeah, so let's just back up for just 1 second and talk about our philosophy. There are three characteristics that we look for in every portfolio holding. We need to see fundamental strengths. We need to see, as you alluded to, sustainable business advantages, and we need to see compelling valuation. And in that framework, we think that if we get that right, we can be competitive with the Russell 1000 Growth Index that we benchmark ourselves to over a long period of time. And then diving a little bit deeper into sustainable business advantage, there are three characteristics we look for there. And the first is if the company is selling a product or service to help their customers become more efficient or more productive, thinking of saving on water and energy and electricity and so forth. Number two would be if they're a great sustainability steward and they do a great job in lowering their cost of doing business by reducing their energy and electricity and water and raw material usage and really stand out in the industry from that standpoint. And then three, if they're driving customer loyalty through a consumer brand that's built around sustainability. So those are the three tangible ways that we think a great fundamental company can become even better by using one of those three sustainable business advantages.
Great. Okay. Well, let's focus now on the growth aspect of the fund, because there's a lot of talk at the moment, as you'll be aware of growth and value. Your focus is on growth. I just wondered if you could talk a bit about that, and specifically how the fund is likely to fare if we do move into a higher growth environment, as some people think we will.
Right. So we are a growth manager. So that is one of our characteristics. And then just to back up a little bit more, we think that the best companies win over the long term. And if we can own those compelling best companies, we can put up some good numbers and be very competitive with the Russell 1000 Growth Index. And so some of the characteristics I've already talked about: great fundamental strengths, business model, great management team, great value add, using that sustainable business advantage to advance your company forward. Another characteristic is compelling growth opportunities and a market that's big enough that your company can reinvest year after year after year in growing their sales force or innovating or buying other companies, and having that ceiling, if you will, be very high. And so that's one of the characteristics that we think makes really good companies great and is what we look for. Will we be able to outperform in every type of market? Probably not. There's certainly going to be markets where people want different types of companies than what we have. But over a long period of time, through a market cycle, and this could be 3, 5, even 10 years, we think we can perform very well if we own the best positioned companies out there and own them in a concentrated portfolio of best ideas.
And obviously, identifying the growth is important, finding the high quality companies, but the other part of the equation is obviously not paying too much for that growth. So how do you approach valuation? How do you make sure that you're not overpaying for that growth?
Right. We have a scenario analysis that we use where we model out a company's financials, their revenue, their operating profit, their cash flow for the next 3 years. And we do that on an upside scenario case and a downside scenario case. So if the company is really performing well or better than expected, what does that look like over the next 3 years? And if the company disappoints and it's basically vice versa, what does that look like in a disappointing standpoint? And then we assign peak multiples to that upside case and trough multiples to that downside case to get a pretty good sense of a range of outcomes in terms of a risk reward standpoint, or even more so, how much money could we potentially make on this investment, or how much we could potentially lose over the next 3 years. And we try to remain patient to not pay too much in terms of having a lot more reward than risk. And that risk is certainly something that we concentrate quite a bit on, especially today when valuations are very stretched. So we avoid a lot taking part in a lot of companies because there's a tremendous amount of risk if we're wrong, and that's why we're very selective. And I think that valuation framework helps us quite a bit.
Yeah. Now, obviously, we've talked about growth and sustainability. I guess the twin focus on those two factors means that you're looking more at certain parts of the market, certain sectors and industries than others. Maybe you could just give us a flavor of that.
Sure. Well, I'm sure it's not a surprise that technology is a big part of where we have found good ideas. Healthcare, certainly consumer discretionary. And then on the other side of the coin, we haven't found many good ideas within financials or consumer staples or energy. Certainly traditional energy has never been a part of our portfolio. So I think that makes sense. One of the areas that we are overweight today and have been overweight for a while is healthcare. We found a lot of really good ideas in healthcare and are almost twice the index weight, not because we're calling healthcare from a top-down perspective, but just because we found a lot of really interesting ideas there. And our view is if we find ideas in certain sectors, that's where we're going to be overweight. And now, at least, that's the case in healthcare. And I would say the last point is that technology, healthcare, and consumer discretionary have always been sectors that we found good ideas, and I'm sure we'll find good ideas in those sectors going forward.
Okay, so you talk there about we find ideas. It's obviously not just you. Perhaps you could talk a bit about the team working with you, and in particular, the skills that they have and the experience. Do you have different people looking at the sort of growth aspects, different people looking at sustainability, or is it all in together?
Yeah, very important to talk about the team behind me. And so the most important point, number one, is I am a co-manager along with Karina Funk, and we've been portfolio managers since inception. So we've made every decision together and have come to consensus on every idea and every trade together, and have formed a very good partnership since inception. Behind us is a team of 50 investment professionals, about 15 or so portfolio managers and 35 or so analysts. And then those analysts break down into mostly fundamental analysts, where they're covering the various sectors of the economy. And there are at least 3 or 4 folks on the fundamental analyst team covering technology, covering healthcare, and so forth. And then we have a number of sustainability analysts that are assigned to particular sectors as well. And they help us with that sustainable business advantage that I talked about. They also help us stay out of trouble of companies that have had bad histories with the ESG. And then we have some investigative analysts too, to be exact, and they help us on a project by project basis. They help us go very deep within companies to understand technology, to understand regulation, to understand competitive sets. And so I think it's a great team, and we're operating at a very high level today.
Okay, David, just finally then, obviously the last 12 months or so have been pretty extraordinary, and I think they've been very interesting from a sustainability point of view, maybe perhaps particularly in the social side of things, that ESG you mentioned, environmental, social, and governance. Can you just tell us sort of what you've learned over the last 12 months about sustainability?
Yeah, Tom, I think the first thing is we don't think in terms of 12-month increments. We really think much longer than that, and think that over a long period of time, a business cycle, that companies that are incorporating sustainability and using sustainable strategies can really build on that fundamentals aspect of a company and help them outperform. So that's point number one. I'd say the second point is we've been very pleased in that a number of our companies have started to incorporate diversity and inclusion goals and outcomes into executive compensation. And I think going back a number of years, you didn't see that. And I think that that's a reflection of a lot of things that have gone on in the past year, particularly in the United States in terms of racial injustice and so forth. And I think companies are really responding, and particularly the ones that we hold in our portfolio, and hopefully that will drive good performance going forward.
David, well, thank you very much for that insight into the Brown Advisory US Sustainable Growth Fund. Very interesting. And thank you for watching too. Goodbye.